Okay, let's unpack this. In the world of finance, everyone seems to be searching for that one weird trick, right?
Yeah, the secret signal, the magic coin,
Sure.
something to get rich quick.
It's a constant drumbeat. But our deep dive today uh, takes us into the perspective of an analyst who is, well, fundamentally skeptical of that whole chase.
Absolutely. We're digging into source material that lays out the analysis and perspective of this financial analyst known as Hunter.
Uh-huh.
And he offers a very grounded, data-driven view, often pushes back against the hype.
Right. So our mission for this deep dive is pretty clear.
Mm.
We want to pull out the most important insights from these sources for you, the listener.
We'll unpack his core investment philosophy, get into his take on specific assets like Tesla and Circle.
And understand his concerns about the broader economy, too.
Yeah.
Think of it as getting a clear signal in what can be a very, very noisy financial world.
Definitely.
So let's start right at the bedrock of Hunter's approach, because it really begins with a strong dose of skepticism.
Yeah, the material makes it clear he's deeply skeptical of, get-rich-quick schemes, technical analysis, speculative trading, all of it.
He states it pretty unequivocally, doesn't he? Like, trading doesn't work and technical analysis doesn't work, just flat out.
And he explains why he feels so strongly. It boils down to a core belief in market efficiency.
Okay.
He argues that if there were really these profitable secret tricks out there, especially simple ones.
The big guys would find them.
Exactly. Massive institutional funds managing trillions. They'd have algorithms sniffing these out instantly that exploit any tiny edge until it just vanished, leaving nothing for regular retail traders.
Right. And he uses some pretty vivid language in the sources about it, satirizing chart patterns.
Oh yeah, looking for things like a dragon head and shoulders or a Teletubbies picture on a chart.
She believing in Santa Claus or the Tooth Fairy. Ouch.
It's harsh, but his point is that he sees that kind of thinking as, immature. Investors just looking for an easy button instead of doing the actual hard work of analysis.
So for him, these patterns aren't real market inefficiencies.
Not in a way that small players can reliably profit from, no.
Yeah.
Believing in them suggests you're not really engaging with the fundamentals, where the real, sustainable edges are tiny and very hard won.
Okay, so if that's what he's against, what's his path? What does he recommend?
His core strategy, as laid out in the sources, it's rational, data-driven, long-term, buy and hold.
Built on fundamental analysis.
Entirely. And a deep understanding of market risks, not just hoping a chart looks right.
He emphasizes his profits come from these long-term investments, not trading.
Right. He does mention having a couple of tricks that let him consistently outperform the stock market.
Ah, so there are tricks.
Well, the sources suggest these aren't secret trading signals. It's more likely about superior fundamental analysis, maybe looking at data differently, using better models.
So the trick is just being really, really good at the analysis part.
Exactly. The rigor and depth of his analytical process, that's the edge.
And to kind of build trust, the sources say he's willing to share his own investment balances.
Yeah, and he also makes a point that income from any courses he might offer is small profit for him, trying to distinguish himself from people whose main gig is selling that dream of easy wealth.
Okay. Building on that foundation then, a really critical part of Hunter's view is understanding and managing risk. He makes a sharp distinction.
A very key concept for him, yeah. He talks about market risk.
That's the risk the whole market goes down, basically.
The inherent risk. And according to Hunter, this is the only risk in investing that has positive mathematical expectation.
Meaning you get paid to take it over the long term.
Pretty much. You're statistically likely to get positive returns for bearing that general market risk because economies and companies, tend to grow over time.
Okay. Market risk is compensated. What's the other kind he highlights?
The other is idiosyncratic risk. That's the risk tied to one specific company or industry or asset.
Like picking just one stock.
Exactly. And investing in individual stocks without doing that proper, deep, fundamental analysis introduces what Hunter calls additional risk with negative mathematical expectation.
Negative expectations. So you're taking risk you don't get paid for?
Worse than that, actually. It's likely to lead to underperformance or losses compared to just owning the whole market, because you're exposed if that one company hits a snag without the cushion of everything else.
That's a really powerful distinction. Compensated market risk versus uncompensated idiosyncratic risk. So what's the practical advice then?
His strong advice, and lines up with modern portfolio theory, is diversify. Get rid of that uncompensated idiosyncratic risk.
Wow.
For smaller portfolios, say up to $100,000, his recommendation is really direct. just sitting in ETFs, exchange-traded funds.
And he mentions a specific one, doesn't he?
He does. VT, the Vanguard Total World Stock ETF.
Why that one?
He likes its global coverage. It provides more papers, meaning exposure to thousands of companies worldwide. So you get greater diversification, less idiosyncratic risk.
The idea is you're mainly just taking on that compensated market risk.
Exactly. Rather than betting the farm on picking the one right stock.
The sources also hint he gets into more advanced stuff too, like options or tax strategies.
Yeah, it touches on that. Acknowledging options for portfolio insurance can be normal. And there's mention of more complex advice for high-tax situations.
Like using accumulating ETFs.
Right. Those reinvest dividends automatically, which can help defer taxes. And borrowing against assets for liquidity without selling, it shows his thinking goes beyond just picking stocks to like holistic wealth management and preservation.
Let's talk about actually building that wealth, because Hunter describes the process in a way that really hits home.
Yeah, he says the first $100,000 are truly the most difficult. Really emphasizes that.
But then, strikingly, she says after that, it's very simple with every new 1,000. And the second million is collected many times easier than the first.
And it's not just compounding, though that helps, obviously. He explains why it gets easier.
What's the reason?
For small amounts of capital, you're often fighting systemic barriers. Things like currency risks, navigating regulations in different countries.
He mentions some specific examples.
Yeah, referencing things like the hryvnia exchange rate, NBU bans, local central bank stuff, or even just the general risk of the government always taking things in less stable places. These hurdles are disproportionately tough when you have less capital.
So it's harder because you've got limited tools and you're fighting uphill against the system.
Pretty much. But once you build a larger capital base, you kind of unlock a higher tier of the financial system.
How so?
You get access to crypto, global stock markets, other jurisdictions. You can work with different capitals, tax numbers, and so on. You have the resources to navigate the complexity, find more opportunities, manage risk across different systems. It's about getting over those initial roadblocks.
He's also really pragmatic about where people should focus first, isn't he?
Very. Like, if spending $200 on a course feels like a big investment, his advice is blunt. Prioritize earning more money first.
Go develop valuable skills.
Yeah, like programming, he suggests. His point is, you need a solid income and a starting capital base before you dive deep into sophisticated investing. Otherwise, you feel pressured to take bad risks with the little you have.
Makes sense. Okay, let's look at how Hunter applies this analytical lens to specific assets, starting with Tesla.
Right. He definitely acknowledges Tesla's strengths, calls it the most technological product, highlights its efficiency compared to old automakers.
But he also points to some serious headwinds right now.
Yeah, a big one he notes is losing that $7,500 US EV tax credit for a lot of buyers. He sees that as a clear deterioration of the financial situation. Tesla takes away a huge potential demand subsidy.
Plus political issues.
And political obstacles, yeah. And then there's competition.
Particularly from China.
That seems to be a major concern for him. He mentions companies like BYD arguing they've learned a lot from Tesla.
So Tesla's edge is shrinking.
He feels its main remaining advantages, the top software, the supercomputer for self-driving, are becoming reproducible, especially since there aren't really scientific embargoes stopping tech transfer to China in this area.
And he warns about Chinese EVs entering the U.S.
Yeah, he specifically warns that if they manage to enter the U.S. market at scale, it'd be a huge disruption for Tesla.
There was also an interesting observation in the source material about Elon Musk's motivation.
Right. He notes Musk is now working 24/7s, specifically on Tesla. Hunter speculates that this intense focus might be partly driven by a need to hike this stock.
Why?
To get his boosts and bonuses. Because so much of Musk's personal wealth is tied up in Tesla stock options and ownership. It's an observation about potential personal financial incentives maybe influencing his actions.
Interesting angle. So, given all that, what's Hunter's investment take on Tesla right now?
He advises not expecting a near-term zoom-moon, slang for a huge sudden price jump. Too many current challenges.
So
He considers the current price basically a hold. He'd only think about buying more if it dropped quite a bit lower. Specifically says he'd buy more if it got cheaper than $200.
Okay. Let's switch gears to Circle, the company behind the USDC stablecoin. Hunter has a really provocative way of describing their business model.
Yeah, he frames it as Circle essentially printing money by issuing USDC.
How does that work?
Their income comes from taking the real dollars or assets people trade for USDC, and then investing those reserves, buying bonds, assets, maybe partially Bitcoin, and earning yield on that massive pool of capital.
Which led to that striking analogy he uses.
Right, he calls them an investment company / central bank by analogy with the Fed.
A central bank. Wow.
His point is they create this digital currency, USDC, and then they take the backing assets and mostly buy government debt to earn yield. Similar to how central banks hold government debt, it puts them in this really significant, almost macro financial context.
The numbers cited show incredible growth, right? Revenue from $15 million in 2020 up to a projected $1.7 billion in 2024.
Explosive growth. And projected profit around $155 million for 2024 so far, or maybe a $500 million annual run rate based on Q1. Huge numbers.
But even with that growth, Hunter looks at the valuation, what, $25 billion?
Yeah, somewhere in that range. And he finds it a bit expensive yet compared to those profits.
He notes the IPO price versus the opening price, too.
Right, IPO'd at $31, opened around $66, and people were still piling in. He calls that huge mispricing and expects it to level out, meaning come down.
And he points to a key red flag that makes him cautious.
This is crucial for him. First, he speculates, and it's a strong claim, that some numbers might have been artificially boosted for the IPO prospectus.
Okay, that's one thing. What else?
More importantly, he observes that retail is mostly buying this company, not institutional investors.
Why is that a red flag for him?
Because the lack of big, informed institutional money buying at these levels is a major warning sign. It suggests the price might be driven more by retail excitement and hype rather than solid institutional due diligence.
He even compares it to another big crypto-related IPO.
Exactly. He draws a parallel to Coinbase. Massive initial hype, sky-high valuation, then a big price crash. It only became attractive, in his view, after dropping significantly.
And he expects something similar for Circle.
He expects a repeat, yeah. His advice is basically wait for a substantial pullback. Suggests maybe 70, 80 before even considering buying it.
Got it. And just quickly, there was a point about the Kyivstar IPO. He used it as sort of a cautionary tale on valuation.
Yeah, he expressed serious doubts about getting involved, even joked he was most likely clueless about its viability based on the early info.
What were the specific concerns?
Mainly the preliminary valuation estimates he'd seen. He felt they were losing competition even to American LEC giants per user.
LEC giant per user, like value per subscriber.
Exactly, a common telecom metric.
Mm.
He thought Kyivstar's proposed valuation per user just looked way too high compared to established players in other markets.
And he suggested a way for investors to kind of double-check the IPO hype.
Yeah, a classic approach. Analyze the market cap of the parent company that owns Kyivstar. If you figure out the value of the whole thing, you can estimate Kyivstar's value as just one piece of that puzzle.
A sum of the parts valuation.
Right. A way to try and find the intrinsic value, not just the potentially inflated IPO price, reinforces his focus on fundamentals over hype.
Okay, shifting from specific companies now to the really big picture. Let's look at Hunter's view on the macro and geopolitical landscape. It sounds like this heavily informs his cautious stance sometimes.
It definitely does. He expresses significant and growing concern about U.S. government debt and social spending commitments. It's a major theme.
The sources mentioned a fascinating story about a past initiative to tackle government spending.
Oh, yeah, the DODGE initiative, Department of Government Efficiency, involved Elon Musk during the Trump administration.
Aimed at finding huge savings.
Trillions, that was the ambition. But Hunter notes the actual results were, well, tiny in comparison. Around $160 billion a year, maybe, which he said was, softly speaking, way too much below the target, a massive shortfall.
And he sees specific reasons why it failed, reasons that matter now.
Absolutely. He chalks it up mainly to the human factor and people's unwillingness to change and be fired. Basically, bureaucratic inertia and resistance.
People digging in their heels.
Exactly. And he points out that after the political push faded, they even started trying to rehire people who'd been let go. For Hunter, this failure, even with big names involved, shows just how incredibly hard it is to actually cut government spending in a meaningful way.
And he connects that failure directly to where we are now, financially.
Precisely. He sees this deep-seated resistance to cuts, and a key reason why we keep seeing new large spending bills. He specifically mentions one projected to increase U.S. state spending on its Social Security and pensions over the next 10 years by another $2 trillion.
Wow. And his conclusion from all this for the U.S. dollar?
He believes this path points towards an even greater fiscal crisis down the road, which, in his view, will inevitably push toward the dollar's further devaluation very soon.
devaluation. How?
His prediction is the Fed will eventually have to return with its printing press, meaning more quantitative easing, expanding the money supply, basically, to help finance all this debt.
Which leads to a critical question.
Yeah, he raises the really tough one. The question is who will only buy U.S. government debt? If the fiscal situation keeps looking worse and the currency is expected to lose value, who keeps lending?
It sounds like he sees crises not as like black swan events, but more as just part of the deal.
He states it explicitly. Crises are inevitable because that's how the economy works. It's cyclical.
Does he predict the next crisis?
He doesn't claim to know the exact trigger or timing, but he says he'd bet on something like a private equity crisis or a fiscal crisis or a crisis of changing the financial system in principle. And crucially, he notes he's already betting on this, meaning he's positioning his investments with these potential outcomes in mind.
Okay, so to kind of wrap up this deep dive into Hunter's analysis, what we've really explored is his pragmatic, principles-based approach, grounded firmly in fundamental analysis.
Deeply skeptical of hype, quick wins, emphasizing understanding and diversifying risk, often favoring those broad ETFs like VT, especially for most investors.
And his analysis of specific companies like Tesla and Circle really shows his method, doesn't it? Looking past the headlines at fundamentals, competition, even potential leadership incentives.
Yeah, and all of that is set against this backdrop of his, frankly, quite cautious view of the macro landscape. Big concerns about U.S. fiscal policy, potential dollar devaluation.
It really offers a powerful framework, I think, for cutting through all the noise out there, focusing on what might actually matter for long-term wealth building and preservation, discipline, analysis, risk management.
It's about asking the right questions, isn't it? Seeking that deeper understanding. It's a reminder that, sustainable success probably comes from reasoned strategy, not just chasing signals or hoping for some kind of magic bullet.
Absolutely. And thinking about Hunter's analysis of that DOGG initiative, how even efforts led by really influential figures struggled so much against that systemic human and bureaucratic resistance to change.
Yeah, that point about inertia being so powerful.
Right.
Yeah.
And his resulting prediction of more spending, fiscal crisis, dollar devaluation, it leads to a provocative thought for you, the listener. If that fundamental resistance to efficiency is that strong, what does that imply about the inevitability of the kinds of fiscal and currency challenges he outlines? Regardless of future political promises or intentions, what stands out to you from this deep dive?